Jonathan Barrett from Commodity Broking Services across that side of the story. Jonathan, good morning to you. Interesting how we didn't get necessarily the pass-through straight away. Is that just all to do with timing on a lot of those commodities having wound down from trade ahead of that media conference?
Look, it's when it is all timing, but I think as Phil put it, it's Mr. Bernanke's doing the right thing by commodities traders. You know, the US dollar is weak, it's remaining weak, and as a result of that, those commodities which are priced in US dollars remain firm. It is a double-edged sword, which I think is a bit of a concern because we've got those inflationary expectations around the world, and they're just starting in the US. So let's see what happens, but I think we agree Bernanke's the man at the moment and certainly helping commodity traders who are long.
And what do you make of the language of the Fed believes, quote, in a strong, stable dollar as being in American and global economic interests? Completely the reverse is happening.
Well, look, let's put it this way. This is the first bit of persuasion, where they're saying, well, look, okay, the traders are quite happy to be short, and they're going to add to positions as it continues to approach new lows. But at the end of the day, that persuasion will helpfully try and make the dollar not as weak as what people want it to be. I think technically when you look at it, you are reaching the bottom of the barrel in terms of dollar weakness. Likewise, you're reaching the top for some commodities where commodities are at levels we haven't seen for some time, and it's all false at the moment because, are we getting the numbers that justify the growth in the States, and is that growth purely on the back of the stimulus that the Fed's sort of put into the market?
So, Jonathan, are you suggesting some commodities are worse than others on that front in terms of fundamentals supporting the levels?
Oh, absolutely, yeah. I mean,
Which ones?
Yeah, when you look at copper, for instance, and also you look at oil. With oil last night, for instance, we had the inventories. And inventories are up about 6 and a bit million barrels. Now, that's levels we haven't seen since November 2010, when crude oil was actually trading at $84 a barrel. So when you see it at $84 a barrel, when we're at the same level of inventories, we're not seeing this consumption occurring. You're seeing crude just trying to push through new highs at about that 113.50. If it breaks through there, then traders will react and probably take oil even higher, which is not going to support the economy, particularly support that economy, particularly when you look at the primary inputs being so high. It'll just stall. That's why Ben wants to continue to keep interest rates low. He's got no choice.
And Jonathan, because there's this sense from a lot of our guests on the morning programming that with what was said today, it's buy up risk assets without discretion, just go get in there, buy up. You just heard Phil saying Bernanke's the man, commodities traders love him, they're all buying. But there's got to be, you've got to be looking at opportunities, I guess, of value, because in that market, how do you find buying opportunities that actually offer value? Yeah,
look, that's a hard task. Because when you've seen commodities like silver, put on 8%, take off 6%, very volatile, very hard to trade. When you look at gold, gold's on the back of US dollar and inflationary forecasts or expectations. The fundamental supply-demand picture is very steady for this metal, but for gold, yet it keeps on trading higher, and I think that's justified. When you look at oil, fundamentally, it's not justified. When you look at some of the grain markets, believe it or not, some of them still look very, very cheap, given that we're going into concerns in the US on weather and the Ukraine. So opportunities, I think you've still got to look at some of the grain markets, and in fact I'll be looking at opportunities in going short some of the other primary input markets. Copper, for instance, inventories continue to build. Primary users of copper, are slowing their economies. So it just goes to show that when you look at copper, perhaps that should be under pressure, as with zinc, under pressure as well, because these are litmus tests for the actual economies of the world. So it is a mixed bag, and I don't think, as Phil said, you can just jump in there. I think you've really got to look at some of the fundamentals supporting some of these moves.
Do you think there's going to be dip buying demand, though, irrespective, that those falls are simply going to be an open opportunity for other entrants to come in?
Look, I think so. I think there's always an opportunity there. But once again, Carson, it's all about diversifying the portfolio at the moment. because as we're seeing, people have moved out of commodities, some commodities, they're now trying to move back in. They've moved into equities, they're moving into debt. So I think the diverse portfolio is the one that's going to be the one that's going to show the steady returns.
And of that diversification, what weighting would you be giving to the softs in the round, the likes of sugar, for instance?
Yeah.
You flagged wheat, both susceptible and influenced, it would seem, by that fundamental of the weather.
Oh, look, it is, I mean, we have a concern at the moment in the grain picture, the corn, the soya and the wheat. We actually feel that the planting times in the States running short, particularly for corn. Although corn's at those historic highs, there is this chance that corn can continue to trade higher, and that will drag up wheat. It'll also drag up soya. The cocoa I think is fair value. Sugar, in my mind, still remains relatively volatile.
How concerned are you, an oil market strategist at Lind Waldock saying overnight, Jonathan, that crude will continue to soar simply because of US dollar weakness? Now, as the Fed seeks to do the reverse and eventually raise rates, how much of that's going to be thwarted by simply the hip pocket being burnt in the US because of those high gasoline prices, the pass-through?
Look, I think this is one of the hard things, because oil in itself, inventories, we're not consuming what we're producing, although capacity continues to rise. And I think that's a concern. I actually think that there is significant plays on short dollar long commodities. They've been with us for some time, and whenever we see a new breach or a little bit of news, people now add to it. Now remember, crude oil went from $145 down to $35 a barrel in the space of a year or two. You know, like, these sorts of things can occur and will occur, and I think that crude, given that it's not moving as much as, say, some of the other import markets, I think is ripe for a correction. But you can't stand in front of it, and that's what we've learned from history. You can't stand in front of it, you've got to trade with it. And we actually feel, whatever reason it is, a breakthrough $13.50 on the top side suggests that crude can continue to edge higher. Although if the fundamentals don't show it, you've just got to run with it.
So is Ben Bernanke wrong in saying that inflation is transitory? And I mean, he said in the briefing today he believes prices will come down. He talked about oil specifically, saying that stabilises, if not just goes lower from here.
Brooke, I honestly can't see how he can actually say that, just purely because you know, what's happening around the world, what's happening with those other growth economies, what's happening in China, what's happening in India, Korea. You know, Korea put in a massive quarter. You know, all these growth economies are actually putting the brakes on their economic performance via interest rates. China's going to do the same. They're going to put another round of interest rate increases on the map. So I don't think Bernanke is sort of focused, although he is focused on the global thing, I think he's actually trying to placate the market in terms of what's concerning him in terms of inflation. And through using persuasion and a lot of meetings from the Fed ministers, he could actually succeed in that. But inflation, I think, is a real concern at the moment. All we have to do is look at the actions of the number 2 economy, China, in terms of its efforts to slow down her economy.
So what tools are left then? I mean, because he was asked this in the conference, someone said to him, if oil prices don't go down as you expect, what can you do then? And he absolutely dodged that one. He didn't give an answer to that. What do you feel is left?
Look, I think in terms of what he's trying to put together, look, there's not a lot out there, and that's, I think, the people are worrying. It's worrying people at the moment because interest rates are at their lowest levels. Stimulus packages are coming off. We know the government's going to support it. 44 million people are on, you know, food dockets. I mean, that's not a very strong outlook. What can you actually do?
Well, I mean, you could argue that if you deflated, that wouldn't have been the answer either. People keep saying reflate, 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 and that's simply what he has done.
Yeah.
He's really used all the tools at his disposal. He hasn't sat idly by. Put it that way. Give credit where it's due.
Exactly. No, he hasn't. He's trying a lot of things to actually try and activate. But the numbers, I mean, you think of it this way. Durable goods were up last night.
Yeah.
Good number. Bit of a surge, 2.5%. So that's encouraging. But is that surge on the back of the stimulus, or is that surge on the back of proper economic activity? And I guarantee you, it's on the back of the stimulus continuing to occur. So what happens when the stimulus drops off? Perhaps we get to some real solid economic reasoning as to where asset prices should be, and I think that's what we're going to come up for.
All right, Jonathan Barrett, appreciate that insider view. Many thanks.
Thanks a lot.